Welcome back, everyone, to the Audacious Money Witch channel, where we talk about the magic behind the stock market. When the stock you want to buy goes discount mode, that's great news for the buyer, don't you think? What's up, everyone, and welcome back to the channel. Today, we're diving deep into the financial world of a true legend. We're talking about the one and only Warren Buffett and his massive company, Berkshire Hathaway. You might think a company this big would be invincible, right? Well, their latest earnings report just dropped, and let's just say it's got everyone talking. A shocking drop in earnings. In a financial landscape where the S&P 500 is hitting all-time highs, you'd expect a powerhouse like Berkshire Hathaway to be crushing it. But guess what? Their recent report showed a surprising 4% drop in quarterly earnings. I know, crazy, right?
Berkshire Hathaway reporting a small decline in second quarter earnings. Operating profit at Warren Buffett's conglomerate dipped 4% year over year to $11.16 billion. Those results were impacted by a decline in insurance underwriting. Railroads, energy, manufacturing, service, and retail all saw higher profits versus a year ago. The company did warn of potential adverse impacts and what they called considerable uncertainty stemming from President Trump's tariffs. Berkshire also wrote down a loss of $3.8 billion from its Kraft Heinz stake. That has performed pretty miserably. I think it's down 60% over that period of time. One thing that they did say was that currency actually hurt them because they have a lot of loans they take out in things like euros and yen and in other products, too. Most multinationals, it helps them, but it was something that pulled down the earnings results at Berkshire.
It's not something you would
anticipate or expect.
It's like, remember when oil prices fell and there were some airlines were like, oh, this is killing us because we were totally hedged. We really screwed up.
This isn't just a small blimp. It's a huge shift from last year's earnings. In fact, their net income plunged from a whopping $30.3 billion to just $12.37 billion. That's a massive difference. So what's going on here? Well, a lot of it has to do with their insurance businesses. Those guys had a tougher quarter than last year, which really weighed down the overall results. Plus, there was this massive one-time write-down that made things look even worse. We'll get to that in a second. But first, let's talk about the one number that's got people really scratching their heads. The mystery of the growing cash pile. This is the part that will really blow your mind. While the stock market was soaring, Buffett and his team were doing something completely different. They were sitting on their hands. Instead of buying more stocks, or even repurchasing their own shares, they let their cash pile grow to an absolutely insane record-breaking $344 billion. That's right, $344 billion. What? Now you might be asking yourself, why would a company with that much cash not put it to work? This is where it gets interesting. Warren Buffett has always been about finding great companies at a fair price. But right now, with the market so high, it seems like he just can't find anything that meets his strict criteria. As one expert put it, he's being patient, which is something he's been doing for several quarters now. But for investors, this lack of action is raising some serious questions. He probably feels that there's less opportunity to allocate their capital at the moment, and he's talked about being patient.
Now, Berkshire Hathaway shares have been underperforming the S&P since Warren Buffett announced his plans to exit his role at the company. Now, if the company's B shares end July in the red, that would be their longest streak of monthly losses in 3 years. And Buffett himself has even tempered expectations for the stock going forward because of the sheer amount of cash that Berkshire is actually working with, having to toil around. But our next guest says his view on the stock is very simple. Just buy it. And he's here to tell us why. Joining us now is Carter Braxton Worth, founder and CEO of Worth Charting. Carter, this is a pattern thing that's developing among the charts for Berkshire Hathaway's shares that you feel good about. Why do you feel so good about Berkshire's shares right now?
Well, a lot of things going on, but great to see you, Dom. The first thing is, of course, this weakness, the current sell-off, the non-participation in the market rally is not unique to Berkshire. Insurance stocks in general are under pressure. Progressive, AIG, Chubb, Aflac. And so if you look at the S&P 500 insurance group, just a fraction off the April low where the market's up 30%. But this chart on the screen really tells a tale, and it speaks to Warren Buffett's timing. This is a ratio chart, Berkshire's relative performance to the S&P. And of course, his all-time high in performance was on the low in 2009 because his stock was going down less than everyone else. And you see that annotated in the financial crisis spike. It took 25 years to get back to that level on a relative basis. And he literally announced his own pending retirement at the end of this year in May of this year. And that was a new all-time high for relative performance. But let's look at something more immediate, the here and now chart of Berkshire. And so if we were simply to look at Berkshire's ascent over the past 3 years, you have had, count them actually, 9 distinct sell-offs of 8 to 15%. The average is about 11.5. The current sell-off is 13, and we think it's just a normal dip, correction, drawdown, sell-off, drop, decline, whatever nomenclature one prefers. It's a counter trend and an ongoing uptrend. And the third chart might depict that very well-defined uptrend. That's the same chart, just with well-defined lines, mathematically parallel lines. We're at the bottom of this well-defined channel. The channel begins from the bear market low of 2022. At that point, of course, the S&P was down 27%, the NASDAQ was down 37%, and Berkshire stock down as well. But this is what GARP looks like to my eye. Buy into the weakness, my thinking.
The $3.8 billion write-down. Now, for that big write-down I mentioned earlier, Berkshire took a massive $3.8 billion hit on its investment in Kraft Heinz. Why? Well, Kraft Heinz has been struggling with inflation and changing consumer tastes. With Berkshire giving up its board seats, they had to restate the value of their investment to what it's actually worth on the open market. This wasn't a total surprise, but it was a huge non-cash blow to the quarter's net income. It's a prime example of how accounting rules can make a company's financial picture look way different than the reality of its day-to-day operations. This is why Warren Buffett always says you should focus on operating earnings, not just net income. And when you look at those operating earnings, things weren't as bad as they seemed. The secret silver lining. So here's the hook that most people are missing. While they reported operating earnings were down 4%, that number is a bit misleading. Why? Because of currency fluctuation. Berkshire has depth in other currencies like the Japanese yen and British pound. When the US dollar weakened, those currency moves caused a one-time non-cash loss of $877 million. If you adjust for that, Berkshire's operating earnings were actually up 8%. That's a huge difference. Their key businesses like the Burlington Northern Santa Fe Railroad saw a 20% gain in operating income. Their utility business was also up 7%. So despite the headlines, the core businesses are still chugging along just fine. Buffett's legacy and the road ahead. The big news on everyone's mind is Warren Buffett's upcoming retirement as CEO at the end of the year. Greg Abel will be taking over the reins, but Buffett will stay on as chairman. What does this mean for the future of Berkshire Hathaway?
Look, Greg Abel has been at Berkshire for 20 years. He's been running the day-to-day operations for several years. He's steeped in the investment process of Buffett and Buffett. There's not going to be wholesale changes in their investment strategy. Clearly, he's going to want to put a stamp on the company as the new CEO, but he's not going to go off the deep end and start doing high-frequency trading or anything like that.
Well, with Buffett's legacy of being patient and his massive cash pile, it looks like Abel is set up for success. The big question remains, will they finally start putting that cash to work, or will they continue to sit on the sidelines? One thing's for sure, with the valuation that's recently contracted, it's possible we could see them start buying back their own stocks again. So what do you think? Is Buffett making a mistake by holding on to all that cash? Or is he a genius waiting for the perfect opportunity? Let me know in the comments below. And don't forget to like this video, subscribe for more financial breakdowns, and hit that notification bell so you don't miss our next video. See you next time. Bye, everyone.